one standard deviation formula. What is one standard deviation formula? How you can do intraday trade using one standard deviation formula. All these things you are going to learn in this event. So before I will start the event, I will start one survey wherein I will ask one very simple question: how successful you are in trend finding? In trend finding, how successful you are? Please vote for that. Please vote for that, and that survey will be open. So how successful you are in trend finding? In survey only you vote. Do not vote in or put your message. So in fact, if you are, before learning this one standard deviation formula, if you are seriously following our newsletters, what we are giving every week basis on the weekly trend, using the one standard deviation formula, this is the current week's trend. Means this week what is going to happen, based on that last traded date's price we have taken, and based on that we have estimated. Today you would have observed that future has come to 7,705, though it is a special day today. So almost you have come near to 1.236 retracement. Then you have moved off. You have given a trend breakout also. 969 level you have gone. See, remaining couple of days are there. So where it is taking us. So like this way, not only this week, all those previous weeks we have given these things in the entire month of September, and its result we have analyzed at every weekend. So most of the week you have achieved the optimum success. Only 1 week you have achieved partially. And while trading on this also, for a safe trading practice, always I recommend, once the trend breakout given, initiate, and instead of waiting for the optimum target, you can come out once the price enter to the death zone. So this is what I have told, and many of you have already taken the benefit of that. Same thing you are going to experience today also. So today's outcome, what was there? One standard deviation formula. Using this same one standard deviation formula on intraday, today Nifty has opened up at 7720 level as per the NSE data, and this is our calculation for intraday using the one standard deviation formula. I have taken the historic volatility, not the real time volatility. So there 7720 as per the previous day's close, means today it has opened at 7720, yesterday it has closed at 7832 as the last traded price. Based on that value, today we have expected maximum till 7685 it will come. It has opened up at 7720 level, gone down till 7705. Post RBI review, it has come to 7969 level. So almost you have, as per this method, you have almost approached till the optimum target. So this is the power of this method, and this is not a hidden method, this is not a difficult method, this is a very easy method. However, once you use different type of volatility, instead of volatility, if you can take implied volatility, you can make, or you can use it effectively in certain places. Instead of this historic volatility, if you can take real-time volatility, then its accuracy level is entirely different. So these are the things you are going to learn. So what is this formula of one standard deviation? This says price may be, whenever I am talking about price may be the previous day's closing price may be today's open price may be the last week's last traded price. So any one price reference you require. Multiplied with volatility. So this volatility can be replaced by real-time volatility. This can be replaced by implied volatility also. Then this will be multiplied with the square root of the days to hold. Means if your number of days, if you are going to hold this trade for 3 days, 5 days, 7 days, that you have to multiply, and the entire result you have to divide it by square root of 365. So this will give you expected price range. How much expected price range you are going to achieve from that particular counter. But the newsletter what I have given to you in the earlier weeks, I have taken the real-time volatility. I have not taken the historic volatility. So the historic volatility as flagged in the NSE site or as you calculate in your Excel sheet may not match with the volatility what I have used in that newsletter. Just to improve the accuracy, I have used the real-time volatility. However, if you use the historic volatility also, your accuracy will be slightly different, plus or minus 10% from my accuracy level. That will be only difference. So expected price range, once you find out, what does it says? Means today how much oscillation Nifty will give, how many points Nifty will move, or this week how many points Nifty will move. So that parameter is very important. Once we got this parameter, then all our analysis or the future analysis will be easy. So in the future analysis or for analyzing for a trend, analyzing for a trade entry, what are the things we require? We need an uptrend and a downtrend starting point from where this trend is going to start. Then we need one point where the uptrend or downtrend will give a reversal. Then we need one point or the price point where this uptrend and downtrend will give a saturation. This is what we expect from a trend. So all these things we'll be doing using the Fibonacci, but you can also use Elliott, you can also use W.D. Gans principle. So any of these three, once you are calculating the price range, any of these three principle, any one you can use. There is no restriction that yes, you should use only Fibonacci principle. Since Fibonacci principle is one of the easiest principle, so that I have implemented here. So most of you are the known traders, you will be having some knowledge about the Fibonacci. So Fibonacci says that it has ratios 0.236, 0.38 to 0.5, like that it has a growth retracement till 1.618. So whenever any price from its reference point, maybe it is a low, maybe it is high, maybe current price, any reference point, like we are taking that previous day's last traded price. From the reference price, once the price move up to the extent of 0.236 retracement, calculated from a price range what we have calculated using the one standard deviation formula, we can say it is an uptrend. And this uptrend continues till 0.618 without much restrictions or much resistance. Once it enters 0.618 retracement and goes to 0.786 retracement, the probability of reversing from there is more, or price, the trend may change in this zone 0.618 or 0.786. Successfully if it penetrates, then it has all probability to go till 100% retracement. till 1.236 and till 1.618. So these three ratios 1.236 and 1.618 in Fibonacci terms known as the growth retracement. And 0.618 to 0.786 retracement is known as the death zone or the trend reversal point. The second point what I have mentioned. Uptrend and downtrend starting point is nothing but your 0.236 retracement. And saturation point, obviously it is at 1.618 retracement. So the same concept we are going to utilize now. So here I have just taken a small Excel example here. What I did here, I have taken the historic volatility, because the real time volatility you may not be in a position to calculate in Excel. In Excel, the real time volatility is little difficult to calculate. So I have taken the historic volatility. So what I have done here, I have taken the Nifty future last traded price for the last 10 days period. I have taken their logarithmic value, means current divided by previous. Then I have taken square logarithmic value. Then I have calculated the average logarithmic value and average square logarithmic value. Post which I have calculated the variance, and post which square root of variance is daily volatility multiplied with the square root of 365 into 100. It is telling that 22%. So as of yesterday, means as of 28th September 2015, as of 28th September 2015, the Nifty future has a volatility of 22% with reference to its past 10 days data. So using this 22% of the volatility and applied on 28th September 2015 last traded price, I have calculated the price range. The expected price range is 90 point. 90 point of price oscillation you can expect. Then this 90 is multiplied with 0.236 to give the price range of retracement level 0.38 to 0.5, 0.618. So just it is multiplied with those Fibonacci ratio to give you the Fibonacci price ranges. So my reference point is 7832. So I have added 7832 added with the Fibonacci price ranges. I got all resistances in this side. Similar way I have subtracted from 7832 this Fibonacci price ranges to get this support points. So next day I need to see where my price opens, where my price is opening. So we have started with 7720. Today we have started with 7720. Okay, my downside, almost all the levels I have breached. So no opportunity for trade, let me wait. And one major event also is waiting, your RBI's review. And post that review and everything is got over, I got a very successful crossover hour above 7853 and it has moved till 7969 and which is close to your 1.618 retracement. This is how what you have achieved. You could have done a little different, means little changes in this system to derive somewhat more accurate result. Suppose you have opened at 7720. So with respect to the 7720, calculate volatility which is 25.62. So 25.62. So change these things to 25.62 and we are doing for intraday. So my opening price will be 7720. So you will get a renewed level here because almost all the trend points has penetrated on the opening itself, on the gap down opening action itself. Almost all the trend points has penetrated. Then you could have waited for a 7696 or 7744 level to make an entry. If you can see in that term, then you could have got a greater benefit in this particular trade with 2 cycles of profit. So you could have entered a buy trade at 7744. You could have got the maximum profit at 7887, and further 7887 from here. If the second cycle starts, then it has given till your death zone 6.618 to 0.786. This is the death zone wherein your 7969 level you have gone, and from there it has retraced back and it has settled near 7859 level. So 2 cycles of price points you could have encashed based on this gap down action. Whenever there is a gap down or gap off happens above your estimation points, you can change this opening price and get a good entry level. So this is what about the one standard deviation formulae, using the one standard deviation formulae for intraday purpose. So means you need to find out uptrend and downtrend starting point, which is 0.236 retracement level. Then you have to find out the uptrend and downtrend reversal point, which is nothing but your 0.618 to 0.786 retracement level, which is also called death zone in Fibonacci principle. Means from here most of the trends will change. So that is also reflected today. So this is not a word only we are saying. So here this is also reflected today. So second cycle, first you have, if you are taking the observations from 7720, which is the opening price of the day, your first cycle or first uptrend is matured at 7887.5, and if I am taking 7887.5 the second cycle, so you will find out that 0.618 to 0.786 it is a death zone, or from here the trend reversal is possible. So that is what happened, and your 7969 level you have gone, and from there only you have retraced. So these Fibonacci levels never say anything false, rather it holds to its commitment in calculation. So you must trust in these things. So that is what happened today. So this is not being, it is also only opening price you have taken, from there only you have derived. So no big science is also involved, simple calculation on the Fibonacci. So third or last point is uptrend and downtrend saturation point, which is nothing but your 1.618 retracement level. So, and once you are going for the weekly or monthly predictions in this particular method, so here number of days which you have taken for one, you have to be 7 days for weekly prediction. Whenever you are going for a monthly predictions, so you need to leave it for the 30. But on those situations, instead of taking the volatility reference from the past 10 days data, if you can take the reference from the real-time volatility, what is the volatility at 3:30 p.m. of today, or what is the volatility it has given at 3:30 p.m. of the last trading day, then it will be more accurate. So using the same concept, those who are using our software, we have extensively used this concept in our software programs. We have extensively used the same concept in the volatility. We have extensively used in the Fibonacci. We have extensively used in the Elliott principle. We have extensively used in this GFE. However, the price range, instead of one standard deviation formula, we have taken from the directly from volatility. It is more or less mapping to the same price level only. So if you see, we have little bit modified, bring more clarity to this particular calculation. Suppose now the market has ended. Today market has ended. Nifty future for tomorrow. If I can go for this same Fibonacci trend, so it is telling you have closed it at 7859 today. Tomorrow my uptrend confirms above 7879 or 7880, and I will be finding a toughest resistance at 7951, which is called as a cluster. cluster is nothing but it is the maximum resistance point I can feel, and once this thing I can penetrate, I can move to 8,000, and if I can successfully penetrate this 8,000 level, then my level will come from 8,020. Second cycle will start, which has the potentiality to take me to 8,141. So we have just added to modify something on adding in the cluster. We have just modified with some of the logics, but the base principle for all these developments is volatility, or this base principle of all this development is one standard deviation. So only the methods are different. Sometimes it is being utilized with the Elliott, sometimes with the GFE or Gann angle, or sometimes with the Fibonacci. So its uses in different principles only. It is implementation changes. However, the base principle remains same. So this is about the principle of one standard deviation. Next, moving to the next use of this one standard deviation formula. So not only for intraday trade, not only for positional or weekly forecast of the trend, you can utilize this particular concept for building the option strategy also. So before going to the option strategy part, I will just take a couple of seconds to explain smart finance. Before explaining you how you can utilize this same analysis of one standard deviation formula for option strategy, let us understand our products and services. Smart Finance possesses 10 different products. All our products are educational products and software product. Most of our software, volatility software, smart IT, GFE, all this software uses this same concept for intraday need, for positional need. And all our stops comes with some educational literatures. Educational literatures comes with the books written by me, along with DVD courses where in-depth analysis on Fibonacci, in-depth on the Elliott, in-depth on technical is being explained through audiovisual presentation. And software helps you for taking the trade decisions. So most of our intraday software, trend finding software, is empowered with this particular concept. And regarding the sales query, you can call out to this number which is flagging on your screen. For any sales related queries, you can call to this particular number of 98403 48971 or 04464995823. And these are the real-time softwares, and we are the most low-cost real-time software provider. Nowhere in the India you will get a software which is real-time and affordable price. So all our softwares have a annual maintenance charges of 3,500. If you take a full package, entire stops, you also enjoy some discount, which is 64%. Individually, if you buy everything, it is one by one, then it costs 49,000. And if you are buying at a stress, it is costing you 17,500. For all this, all our softwares, only one maintenance cost is applicable, which is 3,500. So this is the prices as of now. So the prices may change in the future. So as of now, this is the pricings. So this is about our product. And you get supporting material, supporting email IDs, everything to clarify your doubts and other things. That is a secondary part of these things. Technical analysis of moving averages, all these things, tomorrow onwards you are going to learn. How many of you, please vote. So you are 260 people approximately now present in this particular room. So give your opinion. Out of how many of you follow any particular method? So Currently 75% of the people voted in this particular survey, and they said that 15% of the people never follow any method. 13% of the people follows, or 14% people follow news and blogs. 68% are saying that technical analysis we follow. 11% of the people say that we follow Fibonacci and volatility rule. If I am not wrong, maybe this 11% of the people, those who are present now, out of 256 people, 25 people are coming in that domain. Maybe that 25 people will be the buyers of the smart finance, or those people, those who are associated with smart finance for a long time, because this is our own innovation. And this 15% of the people, those who say that we never follow anything, so they are in a great danger. So you must not take the trade as a non-serious activity. It is a very serious profession. And second category of the people, those who are also in danger, are the people, those who follow the news and blogs. There someone says something, you are following. You never has your own identity, or you never have your own method to estimate certain things. It is a borrowed thing, it is a copied thing. You are relying on something which is non-trustworthy. So it is my appeal and request to these two category of the people, also the people those who follow the technical analysis. Please follow this method and find out the difference. I can assure you, if you are following technical indicators, averages or oscillators, if you start using this particular method of one standard deviation formula along with Fibonacci, which is very simple to calculate, with one simple Excel sheet itself you can calculate, you will find out your accuracy level will be more than 50 to 60% higher as compared to the technical studies. Technical studies, whatever the accuracy you get, in this particular study, your accuracy or level of achievements will increase to 50 to 60%. If you achieve some 50% there, the accuracy level, here you can comfortably achieve 70 to 80%. That is the level of accuracy it maintains, and it has a great power. So technical indicator, why it is lagging, that I will tell you in the next session, means tomorrow's session, what is the lagging of these technical indicators. However, you can able to improvise that things. It is not that we cannot able to improvise those experience. We can very well improvise this experience. So now moving to the next part, how we can utilize this one standard deviation formula for taking some option strategies or initiating some option trades. If you are a weekly trader, if you are just relying on these weekly levels, so just to say the example here, 24th September we have estimated these levels. Now you got a trend breakout at 7,857 in a simplest way, as a very layman trader. So once this level is reached, definitely you are expecting a 7,800. It's a comfortable achievement. Once this level of 7,857 is broken, you can comfortably achieve 7,795. Also, I have written here, if you have read this newsletter comfortably or very leisurely, if you would have gone through this newsletter, what I have advised here, buying above 7,934, which is uptrend confirmation point, keeping a stop loss 7,858 for initial target of 7,996, or selling at 7,858 with a stop loss of this 35 for 7,795, which is coinciding this one. I am not expecting a very optimum target of 7,633. That is what happened. Monday you have opened. We have never given a breakout at 7,934. You have consolidated, and if you see, yesterday's close, and you have just broken that yesterday 57 broken, you have settled at 7830 level, this level. So this confirms that you are going to have some dip. Today you have straight away opened at 7720 level. So if you have taken a positions for weekly perspective, you can do the trade in that order. Or if you are an option trader, once this trend is broken, I can comfortably buy 7800 put option. If I am a hedger, if I am a very simple hedger, hedging, I do not want to sacrifice if the trend reverses and I never get any opportunity. Once this trend is broken at 7857, I am expecting 7800 to come. I'll buy 7800 put option and I will sell a 7600 put option. Nothing wrong in that. Simple bear spread. If it reverses and goes to 7934, it is a bear spread, impact will be very less. Looking at this particular trend parameter, I can do simple hedgings with no big bang mathematics or big bang hedging techniques, but still I will be benefited out of that. Same way, if the uptrend 7934 is broken, it has today you have 7959 level you have settled. So we are expecting a comfortable journey till 7996. So in this particular situation, buying 8000 call option and selling a 8150 call option also advisable. If it reverses, goes to 7857, book loss and come out. If it successfully, as per our estimation, goes and enters to this death zone of 8023 or something, in this particular zone, our bull spread will be at a great profit. We can just make some profit and come out. Simple hedgings you can do: bull spread, bear spread, saddle and strangle, definitely having a time value decay part. I am not talking about any complex strategy. I am talking this is simple bull spread, simple bear spread, net debit bull spread or net debit bear spread will be very beautiful strategies you can form. You can form beautiful calendar strategies also. Like you can form net debit calendar spread strategy, means buy next month's 7800 put option. Sell this month's 7800 put option. Once it comes to here, your profit will be great, though it will be small. Once it reverses and goes to 7934 level, the losses will be very negligible. You can come out from that. So beautiful net debit calendar spreads, net credit bull spread or bear spread. Just by watching these trend levels, you can make amazing trades and very successful trades in the option hedge. So this not only helps you for intraday trade, this not only helps you for looking at the weekly levels, this also helps you in a great way for forming the option strategies. So in many different ways you can utilize this one standard deviation formula, and it is a tested concept. I have tested it for many years before giving it in the public domain, and I'm also giving you in this Excel sheet. You can backtest it and check it. There is nothing hidden. This calculation is well before you. I am not seeing that things. Please vote so that I should know how many of you are confident, and it is my pleasure to share with you that 33% of the people out of these people are saying that they are very much confident. 61% says that they need to understand this thing and need to work on that handout for some time, and 5 to 6% of the people say that they never understood anything. So those who never understood anything, their population is very low. So I will again request them to grasp it slowly, and whenever if feasibility comes and we share those recordings, please go through that time and again, and definitely it will help you to understand those concepts. But how we can estimate the trend, or how we can estimate the how we can make a trade forecast or trade entry. So one standard deviation formula says that price multiplied with volatility multiplied with the square root of days on hold divided by square root of 365. This will give you the expected price range. The amount of price expectation you are or the amount of price you are expecting to come in that particular counter. I have also given one example here. If Nifty is at 8475, annual volatility is 17.15. So for 10 days period, if I am taking, I am expecting a 240 points of move. So this is as per our requirement. We will use this formula whenever we need for intraday. We will days, number of days holding, we have to make it 1. Whenever we require for weekly, we have to take it 7, not 5. 7 days we have to take, because this 7 days is considered as a week. Maybe trading days not counted, you have to take the calendar days. If you take for 10 days or 15 days, you have to give it here. The basic logic of taking the calendar days are that because you are getting the interest on your capital based on calendar days. Banks never says that we will not give you interest on Saturdays and Sundays and holidays. You get interest on the holidays. So money component has a value on the holiday also. Your money of 100 rupees never lost its value in the holidays. So that is what we used to take the calendar days. So next, after calculating this price range, we have to use any one of the principle, either it is Fibonacci or Elliott or Gann method, to find out a trend and make a trend entry. While finding out a trend, we have 3 critical job to do. One, we have to find out the uptrend or downtrend starting point from where the trend will start. Uptrend downtrend reversal point from where it has the probability to reverse, and saturation point, uptrend and downtrend, where it will saturate. So for that, in Fibonacci principle, whenever the price move above 0.236 retracement, we used to say that it is uptrend is confirmed or downtrend is confirmed. Whenever the price is in the 0.618 to 786 range, we used to say that maximum reversal happens in this particular zone. If successfully this zone is penetrated or this retracement level is penetrated, you may aim for 1.236 and 1.618 retracement. So this is called your growth zone, or this is, as per the Fibonacci, this is the trend saturation zone. So as per this principle of Fibonacci and other things, I have utilized this one standard deviation formula here. So what I have done here, I have taken your Nifty last traded price, which was 7830 before. I have just changed it. So 7830 level, it was closed, and based on that we have calculated a volatility, past 10 days data. 22 point volatility was there, so 22% volatility was there. 2206, this is the was there, and 7830 level we have closed yesterday. So it is one for intraday we are going to use. So number of days 1. Based on this, we have estimated. We are saying that if it is coming, means today, it is as per the yesterday's data. Today, if it is open above 7851, trend is off, we will buy with a maximum expectation of 7976. If it is fall below 7808, then we can sell it with a minimum expectation of 7683. And this is your death zone, 0.618 to 786 level. We have maximum probability to change. However, today there is a gap down opening 7720. Hence, we have just removed the last record in this, change the volatility. So that says that this gap down has increased the volatility, which was before 22%. Now it is 25.62, 25.62, and the price point also will change, which is 7720. Based on this level, we have got it that if the price fall below 7695, we have all probability to fall till 7552. If it manages to cross over 7744, we have all probability to touch 7887. The uptrend confirmation has come post RBI review, and you have achieved 7887. Post 7887, the second cycle will go. So 7887, if I move it here, so it has told that till 8058 is my target. However, my death zone is sitting at 7952 to 7970. That is what happened today at 7969 point something. It is exactly at 7970 level. You have retraced back and you have settled at around 7859 level. So this is what happened in the Nifty today as per the one standard deviation formula, and the levels what you have calculated, that is sufficient enough to prove that this works in the intraday. So this is how I